with any passing of a loved one, you want to make sure that you're taking some time to handle the necessary funeral arrangements and any other requests that your spouse had to make sure that you remember them and the good times that you had. Many experts recommend taking anywhere from 6 to 12 months to make any major financial decisions, especially those that can be irreversible.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. This week we're going to talk about a topic that unfortunately not a lot of us like to think about, and that is death, and more specifically, what to do if you are widowed. And for many people that have been married to someone for a long time, there's usually one spouse that handles the finances in the household. And if you were not the spouse that was handling the household finances, when your husband or wife passes away, you're often left in a difficult situation because not only have you lost your spouse, but you're really not totally familiar with the possible bills that were occurring in the household and or maybe the assets and where you stand financially. So there's a number of things that you need to be aware of. I'm going to take you through many issues to consider. But first and foremost, with any passing of a loved one, you want to make sure that you're taking some time to handle the necessary funeral arrangements and any other requests that your spouse had to make sure that you remember them and the good times that you had. And next, you want to take some time to grieve and make sure that as you're ready to tackle the finances and any financial decisions that you need to make, that you're in the right frame, both mentally and physically, to make those decisions. Many experts recommend taking anywhere from 6 to 12 months to make any major financial decisions, especially those that can be irreversible. Let's talk about some of the irreversible ones. One would be selling your house. That is something we'll tackle a little bit later. Next would be lending money to relatives. If you think you're in a good financial position, but you're not really sure, you want to hold off on lending any money to anyone. Don't rush to pay off any debts, especially your mortgage. Maybe you feel better having your mortgage paid off, but that might not be the best financial decision for you. And also resisting taking any large retirement account distributions or cashing in any retirement accounts with not really understanding how those decisions might impact you. And you also want to resist making any major changes with your investments. You might have insurance proceeds coming your way. You now have maybe new retirement accounts that weren't yours to manage, and salespeople, financial professionals could be coming at you, pitching different products, and you want to really avoid making any decisions, especially buying any annuities or any other products that might tie up your money for years, because you never know when you might need those access to those funds. And statistics show that generally there's more women being widowed than men. According to the Census Bureau in 2016, roughly 34% of women 65 and older were widows, whereas it was only 12% of men over age 65. And husbands tend to earn more than their wives, and the loss of that income, husband's income, can really be a big blow, especially if a husband was still working when he passed away. So what are some of the things that you should, a checklist that you should be working through? And I will add a checklist in the show notes here of what we discuss. So definitely, after you've handled the funeral, make sure that you are asking for multiple death certificates from the funeral home, the funeral director, because chances are you will need these to settle accounts that your spouse had in their name only. Next, you want to gather your spouse's financial documents, any investment accounts they had, retirement accounts, stocks they owned, mutual funds, bonds, bank accounts, and also gather your own financial documents as well, any accounts that you had in your name, and figure out, add those together, right? Come up with a number to figure out where you stand. you probably want to put together a statement of net worth at this time. And I'll put a link to one that I give to clients in the show notes. And this will just help you to understand what assets you have available to you. Next, you want to think about getting some type of help. And this could be in two forms. One, through a financial planner. And probably a good idea if you're not familiar handling the household finances, handling investments, to consult with a financial planner. And as you know from past episodes, I strongly urge clients to seek out the help of a fee-only financial planner and one that's a certified financial planner, because that way you're dealing with someone who's working as a fiduciary for you, and you're much more likely to get the type of advice that you need. And then you may also need an estate planning attorney to help you with the estate if there are assets that need to be settled through an estate. And make sure whatever professional that you settle on, that they're not pushing you to make quick moves. As I said before, you want to have some time, 6 to 12 months, to really grieve and make sure that you're in the right mind to be making some decisions. Next, you want to notify the Social Security Administration, and you are eligible for a very small death benefit for the Social Security Administration of $255. So a very minimal amount. But the other decisions you have to make with Social Security are whether you're going to start collecting if you haven't been collecting already, or if your spouse was collecting, if you're going to continue collecting off their benefit. So these decisions really depend upon two factors. One, the age that you currently are when your spouse is deceased, and also whether you're continuing to work. As a survivor, you have two options. You can either collect off of your own benefit, just like you normally would be able to. Your full retirement age will be between 66 and 67, or you could delay the benefit up until age 70. If you haven't listened to my episode on Social Security, you should go back and listen to that. But also, you have the ability to collect a spousal survivor benefit, and that can start as early as 60 or 50 if you qualify for Social Security disability. So let's just say you're eligible at age 60, but you're currently working and you're going to continue to work. Well, there is a limit to how much you can earn per year and receive the spousal Social Security benefit. And it would be the same limit that would apply even if you were collecting your own benefit. And that number increases slightly for inflation each year. But if you are collecting before you reach your full retirement age, so let's just say your full retirement age is 66. So from 60 up until the month that you turn 65, you're limited to make $18,960 per year. For every dollar that you earn over that, your Social Security benefit is reduced by $1 for every $2 that you earn over that $18,960. It's very possible that if you make mid 40s to low $50,000, depending on your benefit, you won't actually receive any of the benefit. It'll all be withheld, and then it will be paid out to you when you either stop working or when you reach full retirement age. And then there's also an income limit that if you collect your benefit from the year before you reach full retirement, so let's just say full retirement for you is 66. So from your month of your 65th birthday until the month of your 66th birthday, you're limited to earn $50,520. And every $3 that you earn over that, your benefit is withheld by $1. So in that situation, you're able to earn a lot more money and still receive your benefit. And then, as I mentioned before, when you hit full retirement, there's no limit to how much you can earn and collect your Social Security benefit. So if you're not working and you're in your early 60s, it could make sense to collect the spousal survivor benefit depending on what your own benefit looks like. And then what you could do is you could then leave your own benefit alone. If you remember, I mentioned earlier that your own Social Security benefit continues to grow. For every month that you don't collect it, it continues to grow until your full retirement. And then between your full retirement age, let's just say it was 66 and age 70, that benefit grows by an additional 8% per year, plus any cost of living adjustments that the Social Security Administration receives. So I have a client whose husband unfortunately passed away when she was in her late 50s. She was still working, and she ended up working until her early 60s and started collecting the spousal survivor benefit, and just recently turned 70 and has now switched over to collect her own benefit. And that was by delaying the benefit, collecting her own benefit, she was able to receive an extra roughly $500 a month. And the numbers might be even bigger for you depending on your own record. So that is what you have to consider with Social Security. You can reach out to Social Security Administration and they can walk you through this. Also, a financial planner can help you look at the decisions of when to collect as far as what can make sense to you, because it could be $100,000 or $150,000 decision by doing the right thing for you rather than just collecting it as soon as you can. Next would be to contact any life insurance companies that your spouse had a life insurance policy with. If they had a life insurance policy, that's where those death certificates come in handy. You'd supply them with their death certificate, and the life insurance company would give you the life insurance proceeds. And they usually offer a couple options. One, they can open an account, like a savings account. The money can go into that. They could also pay you out over your lifetime through annuity payments, or they could give you the money or give you a check and you could deposit it into your savings account. Depending on what you're looking at, you might just want to take the money in cash, put it in your savings account, and you could use this money, if you didn't have any other money available to you, to live off of while you're making decisions about what to do next. If your spouse receiving a pension, then you need to notify the pension company. If the pension was, hopefully it was a joint pension, you're still going to receive some type of benefit when your spouse passes away. Maybe the benefit will be exactly the same if it was 100% joint and survivor pension, or if it's a reduced pension amount, you just need to be aware of what that is and, make any adjustments for your situation for what that change could be. Next would be paying any important bills that you have, such as utility bills, right? You want to keep the lights on, make sure the gas bill is paid. If you have a mortgage, make sure the mortgage is still paid. If there's any debts that you have jointly, make sure those are paid, such as a home equity line of credit, a car payment, right? And if there's insurance premiums that need to be paid, either health insurance or life insurance for yourself, make sure that's paid. If there are tax bills, your property taxes due, make sure those are paid. Or if you're paying quarterly taxes, make sure those are paid. And depending on how you want to handle your bills, this might be a good time as well to think about setting up automatic bill pay just to make your life easier. I use bill pay for as many bills as I can so that things are automated and you don't miss paying a bill, because obviously penalties and fees could apply if you don't pay these bills, or in the worst case scenario, if you don't pay something like your tax bill, then your town or municipality might start foreclosure process on you. You definitely don't want that to happen. Next is, if your spouse had any credit card bills that were in their name only, don't pay those bills. You might think you want to pay everything, but these are one of those situations where any debts that your spouse had in their name only, especially credit cards, you may actually get away with not having to pay them back. And every state is different. There's a process that you have to go through when your spouse had any debts in their name. And this is where you may want to think about reaching out to an estate planning attorney that could walk you through handling the estate and how you would handle paying those bills and the process that you'd need to follow. Next would be moving any joint accounts that you had with your spouse into your name. So if you had a joint account, a joint bank account, a joint brokerage account, it's very easy to move that into your name. You reach out to the financial institution, provide them the death certificate again, and this is where these originals come into play because usually they want an original, and the account could then be moved over into your name so you had access to it. If your spouse had accounts that were in single name only, and you don't have a bank account in your name, right? Everything was in your spouse's name, then this is a good time to usually open up a new bank account. But if your spouse did have accounts that are single name only, this is where you may want to think about opening up probate and hiring an estate planning attorney. You can do probate on your own. A lot of people do handle probate on their own. And if you're comfortable with that, could be an option. But this could also be a time to engage an estate planning attorney, because for accounts that are in single name only, you will need to not only provide a death certificate, but also and receive something called a letter of testamentary, which then gives you the ability to go to those financial institutions and move them into the estate name. And then from there, if you're the beneficiary of the estate, then it would be moved into your name. So it's a little more complicated of a process than just an account that is you're a beneficiary on an account or you're a joint holder on an account. Next would be check with your spouse's employer if they were still working when they passed away to see if there's any existing benefits such as life insurance, unused vacation, and or sick days that you might get paid out on. And if your spouse is eligible for any veterans benefits, any VA benefits, reach out to the VA because there also are similar benefits, life insurance, possibly health insurance, other benefits that are available to a surviving spouse. Next is that if your spouse had any retirement accounts in their name, 401ks, IRAs, you have, and you were the primary beneficiary, you have a few different options on what to do with those accounts. So you may be aware that at age 72, it used to be 70 and a half, but it's now 72, there's something called required minimum distribution. And that is the point at which you have to start taking money out of these retirement accounts and paying tax on them. So if your spouse was already over 72 and was taking out required minimum distributions, then you want to make sure you take out the distribution for this year if they haven't already, because if not, that will be penalized. So after you've handled that, you then have two decisions. You can either move it into an IRA in your name, or you can open up a beneficiary IRA and move it from your spouse's account into the beneficiary IRA. So what would really dictate your decision? Well, your age. If your spouse was older than you and you were over 59 and a half, then you probably want to move it into your name, because then you could delay having to take those required minimum distributions. Let's just say your spouse was 75 and you're 65. If you move it into an IRA in your name, then you're now buying yourself 7 additional years by moving the account into your name, where you don't have to take required minimum distributions. Doesn't mean you couldn't take money out of the account. It just means you don't have to take it out for those 7 years. Now, if you were under 59 and a half when your spouse passed away, you might want to set up a beneficiary IRA, because under the current laws, if you inherit a retirement account from someone who passed away, you're able to take the money out prior to 59 and a half and avoid the 10% penalty. So if you didn't know that and you just move the money into your account, your IRA, and you're under 59 and a half, well, you're out of luck, because you're going to have to pay the 10% penalty if you want access to the money. So those are some of the things to think about when you're inheriting a retirement account from a spouse. And there's also another type of an account you could be inheriting from a spouse, and that would be an existing beneficiary IRA. Let's just say your spouse had received a retirement account from their parents or their brother or sister, then you have to abide by the rules of that inherited IRA. And usually with those accounts, you have to empty them out within 10 years. You don't have the same options that we described before, as far as either setting up a new beneficiary IRA, where then you could take out distributions over your lifetime, or setting up moving that money into IRA in your name. Next would be to make sure that you file your spousal tax return for any income that your spouse earned in the year that they passed away, because unfortunately taxes are still due in the year that someone passes away. So make sure you file that tax return. And if you were not doing the taxes, then this could be a good time to engage a CPA to help you at least get done with that tax return, and maybe for future years. This is also a good time to put together a budget if you haven't ever done that before, or maybe creating a new budget, because now your household circumstance could be different. Maybe you have some different bills since your spouse passed away. Some bills have gone away, but you also might have had a change in income, as far as income being lost or income going down. So putting together a budget, this is a really good time to do that. And I'll put a link in the show notes to a budget worksheet that I use with clients. Next would be determining if you need to open probate. And I know I mentioned probate earlier, but probate might not be necessary when your spouse passes away. Where I live in Connecticut, you're supposed to open probate anytime someone passes away. But if your spouse didn't have any assets that need to go through probate, there might not necessarily be a need to open it. And that's where, again, consulting with an attorney to discuss the pros and cons of opening probate could really be helpful. And a lot of this, obviously, is a very overwhelming list of things that I just went through here. And these would be the things that you should think about taking care of in the immediate time frame following your spouse's death, probably in the 3 to 6 month period after your spouse has passed away, that you need to tackle these things. The next agenda items I'm going to list are ones that are very important, but you could take some more time in tackling them. And they would be definitely, once you've opened these if you happen to open new retirement accounts, or if you are just transferring money into your retirement account that you had, it can be a good idea to make sure that beneficiaries are up to date. Chances are you had your spouse as your primary beneficiary, so you might need to update that. If you didn't have contingent beneficiaries, it can be an important time to make sure you have contingent beneficiaries such as your children or grandchildren. And you'd want to update this both on your retirement accounts, and then if you had any life insurance policies or have any that you're going to continue, make sure that you update that as well. Because having things be paid out to people directly, listing them directly on retirement accounts, life insurance accounts as beneficiaries rather than your estate, it's going to really speed up the process of this money getting to these people and also simplify your estate. Next would be to update your own estate documents, such as your will, if your will isn't up to date, or if you don't have a will. If you have a trust, maybe your trust needs to be updated, or if you're thinking about establishing a trust, this could be a good time to do that. You also want to see if your financial power of attorney and or healthcare power of attorney needs to be updated. Usually most couples will make each other in charge of those documents. So if your spouse is now passed away, you need to make sure that you nominate a new person to handle these responsibilities. And it can also be a good time to consider long-term care insurance if that was something that you didn't think about. Now that you're single and your spouse won't be there to possibly care for you, you might want to think about purchasing long-term care insurance to pay for care if it ends up that you need care either in your home or at a full-time facility. And if you have any dependent children, and these might not be minor children, right? If you still have children living with you that are relying on you to keep a roof over their head, pay certain bills, and the assets that you have would not be enough to sustain them, then maybe you want to think about getting any life insurance that you may need now that you're the primary bread earner. Next is if you're going into the workforce, it'd be a good time to update your resume, get online, update your LinkedIn profile if work is necessary to be able to, for you to continue on maintaining your standard of living and paying the bills. And next, it can be a good time to consider downsizing, right? We talked about not making any major decisions in the first 6 to 12 months, but a big decision everyone should think about when they're widowed is whether or not you want to keep the house that you owned with your spouse. If it's a house that is not necessary for you, maybe there's too much maintenance for you to keep up with, or there's just more space than you need, right? You've got rooms you don't even go in anymore, then maybe it makes sense to downsize, free up some of that money to buy another house, maybe without a mortgage, or use that money to live off of in retirement. And there is an exclusion on the sale of a primary residence. There's an exclusion up to $250,000 of a capital gain per person. And if you're married, obviously, you'd have $500,000 of a capital gain that you could exclude. So if your spouse passes away, you're probably thinking, well, I now only have $250,000, but you have a 2-year window that you could sell your house and you could then use this full $500,000. So let's just say you own a house that you paid $100,000 for 30 years ago and is now worth $600,000. So if you were to sell that house today, you have a $500,000 gain. But if you do it within 2 years of when your spouse passes away, then you don't have to pay tax on any of that gain. If you did it outside of the 2 years, then $250,000 would be taxed as a long-term gain. But keep in mind, if the property was held jointly, then you would receive a step up in basis. So you'd only have to pay tax roughly on half of the gain because you get a new cost basis as of the date that your spouse passed away. It's not the basis that you paid to buy the house 30 years ago or however long. So I know this is a lot, but dealing with the passing of a spouse is a very traumatic experience. But from a financial perspective, there's a lot to think about and a lot to get done. But going through the checklist that I'm going to provide can be helpful, or making a list, your own list, can also be very helpful. There's a few books that I've come across that can be good recommended reading. One is My Husband Died, Now What? By Deborah Morrison. Another one is On Your Own, A Widow's Passage to Emotional and Financial Well-Being by Alexandra Armstrong and Mary Donahue. And I'll put the link to both of these books you could find on Amazon and maybe even at your local library. So I hope you found this episode helpful. If this applies to you, I'm sorry for the loss of your spouse, but if it applies to maybe someone you know, a family member or a friend, please share this episode with them so they can use this guide to help get them through this difficult time. And if you're enjoying these podcasts, please leave me a review on either Apple Podcast or whatever your favorite podcast app is. And I look forward to talking to you next Wednesday. Have a great week.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.